Come to IAS 16, property, plant and equipment. So this is a very important standard for exam purpose. You can get a very lengthy question also on this topic, and this may be useful for understanding some other topics also, like for example IAS 20, government grant. Then you can use it for investment property, IAS 40, leases, then intangible asset also, because some concept will be same. IFRS 5, non-current asset held for sale. But very basic standard. Companies invest huge amount of money in property, plant and equipment, and their valuation should be done properly. Based on the value of property, plant and equipment, banks take decisions to grant loan, investors take decision to invest. So if this particular item of asset side is not properly valued and presented, it may mislead the lenders or the investors. It shows that these are the assets which are available for the company and which can be used to repay the lenders or the investors in the extreme cases. Hence, the standard is very elaborate. It covers all aspects relating to property, plant and equipment. What is the objective of IAS 16? The objective of IAS 16 is to prescribe the accounting treatment for PPE. Which item should be capitalized, which item should be recognized as expense. Then it also talks about depreciation. It talks about revaluation. It talks about impairment. Okay. And it helps the user of the financial statement to take a more informed decision about the property, plant and equipment. Now come to para 2. What is the scope of the standard? Where it is applicable, and it is also mentioned where it is not applicable. The standard shall be applied in accounting for PPE except when another standard requires, except when, underline, another standard requires or permits a different accounting treatment. So if any other standard, for example IAS 40, investment property, or for example IFRS 5, non-current asset held for sale, in case if they allow you or permit you to follow different accounting, you follow that. The standard will not apply to following items: property, plant and equipment classified as held for sale, IFRS 5 is applicable. Biological asset, IAS 41 is applicable. This standard, underline, applies to bearer plants. This standard applies to bearer plants, and it does not apply to produce on bearer plants. Produce on bearer plant means, suppose fruit is growing on a tree, the fruit will be covered under IAS 41, the tree will be covered by this standard. The recognition and measurement of exploration and evaluation asset will be covered by IFRS 6. Mineral rights and mineral reserves such as oil, natural gas and similar non-regenerative resources will not be covered by this standard. However, this standard applies to PPE. PP used to develop or maintain the asset. Used to develop or maintain the asset described in B to D. So if you have any plant or machinery for development or maintenance of a bearer plant, okay, it is applicable. Or if you have a plant or machinery for this exploration and evaluation asset, welcome, IAS 16 is applicable. Or if you have any PP item for this category D item, then it is applicable to those PP items which are used for development and maintenance of asset described in B to D. Next is, underline this last line, an entity using the cost model for investment property. Entity using cost model This standard permits two models, cost model and revaluation model. Entity using the cost model for investment property in accordance with IAS 40 investment property shall use the cost model in this standard for owned investment property. So if the entity is using cost model under IAS 40, then the accounting of that cost model will be as per this standard for owned investment property. More about investment property in IAS 40. Now there is a long list of definitions, but they are very simple ones. First we will see what do you mean by carrying amount. Carrying amount means, simply put, your cost minus any accumulated depreciation minus any accumulated impairment loss. So that is called carrying amount. Amount at which asset is recognized after deducting any accumulated depreciation and accumulated impairment loss. Then the question is, what is cost? What is cost? Cost is the cash or cash equivalent paid. In case you have acquired by paying cash, or in case if you have entered into an exchange transaction, the fair value of the other consideration given to acquire an asset at the time of acquisition or construction. So you might have issued shares to acquire PPE, then the fair value of the consideration given. Where applicable, the amount attributable to that asset when initially recognized in accordance with the specific requirement of other IFRS. For example, IFRS 2 share-based payment. So you may have received you may have given the services and you may have received the property, plant and equipment. You may have issued the shares against property, plant, equipment. So in that case, IFRS 2, what is IFRS 2? Share-based payment will apply. So this also we will take soon, you will understand it better. Now next is, what is depreciable amount? Depreciable amount means cost or amount substituted for cost. What is the meaning of cost or amount substituted for cost? In case of revaluation, the amount substituted for cost less its residual value. You must know that we don't depreciate the cost of an asset. We depreciate the depreciable amount of an asset. Is it right? Because this amount, residual value, I am going to realize. Why we need to depreciate that? We are only going to depreciate what will be the fall in the value of the asset. What is depreciation as per this standard? Depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. A very simple definition. Cost of the asset is 1 lakh, residual value is 10,000, so depreciable amount is 90,000. It means I am consuming the benefit of that asset equal to 90,000 over its useful life. Now I have to decide how to apportion that 90,000. Is it right? So that is called systematic allocation. It depends on the nature of the asset, the use of the asset, the circumstances in the business, any legal requirement, and that will help us to decide how to allocate the depreciable amount over its useful life. Now the main definition. What is a property, plant and equipment item? So property, plant and equipment items are underlined tangible items. Tangible but underline, because for intangible asset we have another set of standard. Are tangible item, and it should have following 4 characteristics. First, these are held for use in the production or supply of goods or service. So you have a machinery which is useful for production purpose. You have a time attendance machine which measures or counts the attendance of your employee. That is also useful for service. You have this computer that is also PP because it is useful for rendering of service or for rentals to others. You can give it on rent to others. You can give your building on rent to others. So that is also PPE item. Or you can use it for administrative purpose. Okay. Or you can use it for administrative purpose. So which three purposes they have mentioned? Production, rental, administrative, and one more feature of this PPE are expected to be used during more than one accounting period, more than one period, because normally if it is going to be consumed within the same period, then there is no point in applying this standard. Whatever you have consumed, we will be expensing it out. My idea in this standard is how much amount we will show in statement of financial position. What is residual value? Residual value of an asset is the estimated amount entity would currently obtain from disposal of the asset after deducting the estimated cost of disposal. Why this concept of residual value is there? For calculating depreciation. Depreciation is equal to cost minus residual value upon number of years in case of straight line method. And for other methods also, the residual value is deducted from the cost to arrive at the depreciable amount. Residual value is an estimated number and it might change. What is useful life? Useful life. Useful to the entity, not the physical life. This computer can last for 15 years. I am not going to use it for 15 years. I am going to use it only for 6 years. So for me the useful life will become 6 years only. Okay, some furniture can last for 30 years, but if that furniture is used by a hotel, they are not going to keep it for 30 years. They will replace it after every 3 years. So for them the useful life will become 3 years. Okay, so useful life is dependent on the entity for how many years they want to use it for their business. So it is defined in two ways, one in terms of years and one in terms of output. Useful life of an asset is based on either year or output, mostly year only. Period over which the asset is expected to be available for use by the entity. Available for is underlined. You don't have to actually demonstrate the use. Suppose you buy a diesel generator set. In case if there is a power failure, you can use it. But there is no power failure for 1 year. Still, we will consider it as our PPE item. We will depreciate it. We will count the number of years in that case also. Some asset may be expressed in terms of production units. Like for example, suppose there is a printer which can print a certain specified number of pages only. So 5000 pages. So once that 5000 pages are used, printer's life is over. Or say for example a projector. The lamp of this projector works only for say 4000 hours. So once the 4000 hours are over, its useful life is over. What is a bearer plant? Bearer plant you will come across in IAS 41 also. Okay. So bearer plant, just bring before your eyes a mango tree, an apple tree. Is it right? It bears fruit. So bearer plant is a living plant. Once it is dead, outside the scope of this standard, is used in the production or supply of agricultural produce. So a mango tree produces mango, which is an agricultural produce. Okay, is expected to bear produce for more than one period. Mango tree will produce mangoes year after year and has a remote likelihood of being sold as agricultural produce. The mango tree itself will not be sold. What is sold? The mangoes. Although they can be sold only when as a scrap sale. Suppose it dies, then only it will be sold, but otherwise this itself is not sold. The agricultural produce is sold. So trees which have fruits are bearer plant. IAS 16 is applicable to bearer plant. IAS 16 is not applicable to agricultural produce which grow on bearer plant. IAS 41 is applicable there, right? Now the next is 4 areas addressed in this standard. Which 4 key areas are addressed in this standard? 1. The amount at which asset should be initially recorded. You may incur many types of cost. Are all costs necessarily to be capitalized? That is, we will see. And on that we will be spending half an hour solving many questions also. Then how value change subsequent to acquisition should be reflected in the accounts for both value increase or decrease, which means revaluation. This standard gives a lot of time and space for revaluation of asset also. And then the next is depreciation. Again, many paragraphs are dedicated for depreciation, how to allocate the depreciable amount. And fourth is the recording of the ultimate disposal of asset. So you can say this is my agenda for the day. Okay, initial recognition, subsequent accounting, depreciation and disposal. Now, when should an entity recognize property, plant, equipment as an asset? Okay, you incur some expenditure. When will you recognize it as an asset? First, it should meet the definition of PPE. It should meet the definition of PPE. Even after meeting the definition of PPE, 2 more conditions. It is expected to generate future economic benefit for the entity. If you buy a machine, you will use it for production. You will produce goods and services. You can give it for rental. You can use it for administration. So that is the benefit of this asset for the enterprise. And second, its cost can be measured reliably. The second item should not be a problem, because whatever amount we'll pay, we'll be able to calculate. Of course, in case of exchange of asset, one asset against another asset, sometimes cost may not be reliably measured also. But that should not be a challenge. What about the treatment of spare parts and standby equipment? So what I have done, I have divided that into 3 different points for easy understanding. Spare part. What is spare part? Spare part means, suppose a machine has got several parts, and if some part gets damaged, then that part only can be replaced and the machine will start functioning again. What is standby equipment? Additional equipment. In case if the main asset does not function, main asset itself, then you can immediately use the standby equipment. Like a theater uses 2 generator sets, 2 lifts, is it right? Stepney you use in the car, they are standby equipment. We use 1 extra projector. It is there in the office. In case if it doesn't work, immediately in 5 to 10 minutes we can use that. So what about the treatment of spare parts and such standby equipment? So 3 situations understand. Accordingly answer in the paper and in your offices. Major spare part and standby equipment which are expected to be used for a period of over more than 1 accounting period. Then the treatment will be, they will be separately recognized as PPE and depreciated over their own useful life. So underline the word major spare parts. Next is case 2, spare parts and servicing equipment which can be used only in connection with a particular item of PPE. That means these are non-interchangeable items. They can be used only for a particular item of PPE. So this spare part can be used only for this machine. So I will call them machine specific spare part. So in that case, they will be recognized as PPE. But what about their useful life? Their useful life should not be more than the related asset. It may be less but not more than related asset, because after the related asset is not used, of course this spare part will not be used. So its useful life will not exceed the remaining useful life. And the third case is other items. Other means these are neither major item of spare part nor these are machine specific. In this case, this item will be treated as inventory. IAS 2 will apply. As and when they are consumed, they will be expensed out. And whatever is not consumed will appear as inventory in the SOFP. Okay. Now one question for you. Fill in the blanks yourself. Comment on whether the following items purchased by an entity can be recognized as property, plant and equipment. Small spares of ₹5,000. Standby equipment expected to be used for 3 years. Which is no and which is yes? First is no, don't capitalize it. Write down first answer, charge to SOPL. Second answer, I don't capitalize as PPE. Capitalize as PPE. Below that there is a line. Some item they themselves may not produce anything for the entity, but they are required so that you can derive future economic benefit from other assets. This may not be required. Without this also you can survive, but they are required so that you can get benefit from other items of PPE. So the standard says they will also be capitalized. They will also be capitalized as PP, and one example is printed in the standard itself, that chemical handling plant installed by a chemical manufacturer to comply with environmental requirement does not directly result in future economic benefit. Okay, so because if you want to start a factory, then you may have to purchase certain chemical handling plant. Before the chemical is released in the environment, it has to be first processed through this plant. So to protect the environment, these kind of equipments you have to install in the factory because it's a requirement of the law. Okay, welcome to IAS 16 again, paragraph number 7. PPE is initially recognized at cost. Underline. So day one accounting is cost, not fair value. In many standards you will find it is written that the initial recognition will be at fair value. For example, in IAS 41, biological asset and agricultural produce are initially measured at fair value less cost to sell. In the standard on financial instrument also you will see it is measured at fair value, but this standard says first you measure it at cost. The definition of cost we have seen: cash or cash equivalent paid. In case of exchange transaction, the fair value of the consideration given, or as per other IFRS. Historical cost will comprise of purchase price. Underline cash price only if the terms are on deferred credit basis. What does that mean? Now you have purchased a machinery on installment system. You have purchased a machinery on installment system. For example, the example of this point, you will pay in 5 installment 1 lakh each. And suppose your discounting factor is at the rate of 10%. are you going to capitalize the asset at 5 lakh rupees or present value? 1 lakh paid for 5 years. So take on your calculator first. If you have calculator, 1 divided by 1.10, 5 times equal to 0. Then press GT function. That will give you annuity factor, cumulative factor of 1 to 5 year, and then multiplied by 1 lakh. Multiplied by 1 lakh, how much is that equal to? 3 lakh 79,080. So this is the present value discounted at 10%. This is called the cash price. Student is saying, but we are going to pay 5 lakh to the seller. This is the installment price or hire purchase price. The difference between this 5 lakh and this amount is interest. Okay, the difference is called interest, and that interest will be recognized over that 5-year period. Next is your cost will include non-refundable taxes. Non-refundable taxes means you will not be able to either get a refund or you can adjust it against future tax liability. Example, if you pay GST on input, but you can claim it when you pay duty on finished goods, then it is a refundable tax. Okay, then you will not add in the initial recognition of PPE, you will treat that as a separate asset. But if you can't claim set off of that GST paid at the time of purchase or any tax paid at the time of purchase, add that also to the cost. In case if you have received any trade discount or rebate, if you have received any trade discount or rebate, that will be deducted. Then point number 4, cost directly attributable to bringing the asset to the present location and condition. On this point, I have written about 6 or 7 examples below. We'll come to that immediately after reading this line. Tick mark this item also. Estimated cost of dismantling or restoration of the site on which it is located. Okay. So if suppose it is a nuclear power plant, example, and then after 40 years, you have to dismantle it and restore the site to its original condition. So what you have to do, you have to estimate how much will be the cost of dismantling. Suppose cost of dismantling will be 40 crores and you will incur it after 40 years. So you have to compute the present value of that today. 40 crore divided by, suppose your discount rate is 10% to the power 40. So this will give me present value of dismantling cost, and whatever be that amount, that will also be added to the cost of PPE. Okay, so this point you keep in mind. On this we are going to solve few questions also, but little later. Now first we'll make a list of costs which are directly attributable to bring the asset to its present location and condition. This cost will be added to the cost of PPE. For example, cost of employee benefit. Cost of employee benefit. Some student will say that employee benefit is charged to SOPL. No, not every time. Suppose the employee is working on construction or acquisition of an item of PPE, then with respect to that employee or those employees, the employee cost will be capitalized. Second is cost of site preparation. Okay, in case if you want to construct a building, then the cost of site preparation. In case if you want to install a machine, the cost of site preparation will also be added. Then any initial delivery and handling cost, any installation and assembly cost. Up to this is simple. Now let us discuss point E. Cost of testing. So even cost of testing will be added, whether the asset is functioning properly. After deducting the net proceed from selling any item, underline, after deducting net proceed from selling any item. So this is called, suppose you are doing testing of some instrument. In the process of testing, you might produce some item which you can sell. Okay. So suppose this is an ice cream manufacturing machine and you are testing whether ice cream will be manufactured or not. 100 ice creams you produced, you sold also. What about the sale proceed of those ice cream? So test run cost minus the amount realized from selling of those ice cream will also be considered while bringing the asset to that location and conditions, such as sample produced when testing the equipment. And you can also add the professional fees like architect's fees. If you are constructing a building, an architect may charge you the fees, or if you are constructing a building, project managers may charge you the fees. Any such cost can be added. Legal fees you can add. Now this is a summary of our discussion. Cost of PP will include purchase price, directly attributable cost, decommissioning, restoration and similar liability. And what you will not include, you tick mark this entire box, because there are questions when this item will be there in the list of item and you have to be very carefully ignore such items. Cost of opening a new facility or business, such as inauguration cost. Why these are excluded? Because these are not incurred to bring the asset to their present location and condition. They are not necessary to bring the asset to their present location and condition. Similarly, cost of introducing a new product or service, like for example, cost of advertisement and promotional activity, will not be included, because these are not incurred to bring the asset to its location and condition. They can be avoided and still the asset will function the way the management want them to perform. Okay. Next is cost of conducting a business in a new location, underline. If you are shifting your entire factory from one location to other, all cost of shifting, including the setup cost in the new location, will not be added, not be capitalized. Or with a new class of customer, for example, cost of staff training, will not be capitalized. Administration and other general overhead costs are not to be capitalized. But if you can prove that this overhead was incurred to bring the asset to its present location and condition, so there is an asterisk mark required here. If you can prove that some overhead was incurred to bring the asset to its present location and condition, then you can capitalize that portion of overhead. Okay. Now come to next paragraph 8. This we discussed just now, discounting in case payment is deferred beyond normal credit terms. Now if the payment is deferred beyond normal credit term, it means the supplier is charging you some interest, and that interest will be usually recognized in SOPL. But if that interest can be capitalized under IAS 23, then that interest can be capitalized also. Is it right? Now we will solve one important question where whatever we discussed just now will be utilized. Important question on the screen, in your notes also. Answer is not there, so sad. First you want to try, or you want to try along with me? You want to try first. Wow. Student is saying we want to try. Okay, try. Read the problem. I am not going to read also, otherwise you'll get hint. Suppose this question comes for 10 marks or 15 marks. Okay, now we'll check the answer. Very simple question. Write down. First, right hand side, two columns. Rupees in million, rupees in million. Draw two columns and use small font in writing. First, write purchase price. What is the purchase price of this plant? 200 million. We are going to write rupees in million. Rupees in million. Now the problem says in the second line, the seller granted rebate of 0.5%. So less rebate. Go line by line, will not miss anything. Less rebate 0.5% of 200, right? 0.5% of 200. Is it 1? Say yes. Yes. Then write down less refundable taxes. There are two GST in this problem, which is already included in the purchase price. It is already included in the purchase price. This 200 includes two GST. One 18 million for which you will get tax refund, and one non-refundable GST. So that non-refundable GST I am not going to do anything. That's already there in this. Don't add 10 separately. So 18. Now write down 2-3 simple items. Transportation. How much is transportation? 15. Then you write down below transportation installation. How much is installation? 5. And below installation we have testing and professional fees. Inner column 3. Because there is a note that it earned 0.2 million from selling goods produced out of testing. So my net testing and professional fees will be 3 minus 0.2, 2.8. You can directly write 2.8 or you can present it like this. So let's proceed of produce out of testing. What about the interest? Will you capitalize the interest? Yes, because it is taking 15 months to complete the whole process. Therefore, write down borrowing cost capitalized. Borrowing cost capitalized 100 into 10% into 15 by 12. 15 months divided by 12 months. Inner column 12.5. Sir, why inner column? Because there is one line below. The company earned 0.1 million from short-term parking of money borrowed, pending payment to supplier and meeting all cost. So in IAS 23, it is mentioned that if any income is earned out of temporary surplus, that will be reduced from your interest payment. So 0.1. So my net interest cost, borrowing cost is 12.4. Okay. So my dear students, now you tell me the total. 216.2. So how many of you got it right? Oh, there are students. But you will realize yourself where you have gone wrong also. This is a ruthless exam. They will not give you marks unless that last line was right. Or maybe they can give you say 5 marks out of 10. Okay. Now next question, number 3. No, it's not easy because I have tested this question on many students. Very few of them get it fully right. Question number next. The purchase price of a machine is rupees 1,10,000. Other costs are as follows. Freight add, import duty add, installation expense add. These are all initial costs. What will be the cost of the machinery? Directly answer. Add all these costs. 1,18,000. Nothing is given. All duties and taxes are non-refundable. Okay. For refundable duty, they need to mention it. Try again. One more question. The total price paid for machinery is 1,10,000. This is the basic price of 1 lakh plus VAT 10,000. The entity gets a credit of VAT paid on machinery while calculating the tax payable on the finished goods sold. So this 10,000 you will exclude from the cost. and tax paid of rupees 10,000 while purchasing the machinery will be treated as refundable and hence not included in the cost of machinery. What will be the cost of the machinery? So this actually should be written in the answer, but they have mentioned in the part of the as a part of question only to help you. To write down the answer is the initial cost will be rupees 1 lakh. Okay, one more try. First we'll go through small questions. And then all of a sudden one full page question will come. The total cost of a large computerized machine is 40,000. Butter company do not have enough cash, so they agreed to pay for it a year later. However, they will pay rupees 45,000. Explain the treatment. So 40,000 will be capitalized and 5,000 rupees will be treated as interest cost. Write down. Rupees 40,000 will be capitalized. Rupees 40,000 will be capitalized and rupees 5,000 in bracket 45,000 minus 40,000 bracket close will be treated as interest payable and not included in the cost of the asset Is it right? And not included in the cost of the asset. One more try. This time you try yourself. Give me the final answer. Okay, your chance is over. Anybody got the answer? Keep the answer with you, we'll check. Rohan Limited set up fire safety device around the factory premises. It paid 1,10,000, which includes 10,000 VAT. But you remove that VAT because you'll get a credit for that. Additional cost 2,000 add, import duty 5,000 add, installation 1,000 add. And even you add the initial estimate of dismantling and removal. After the machine was put to use, 1,500 was spent for maintenance. Will you add this also? No. So calculate the initial cost of the asset. Are you getting 1,11,000? So write 1,11,000. Write like this. Purchase price excluding refundable tax 10,000, 1 lakh. Freight 2,000. Import duty 5,000. Installation expense 1,000. Initial estimate of dismantling and removal 3,000. Therefore, total initial cost 1,11,000. And you write one note also. Note, maintenance charges of rupees 1,500 are to be shown as an expense and not as an asset. Are to be shown as an expense and not as an asset. And not as an asset. Okay. Next, question number 7. You note down as homework. Question number 7, write homework. Solve this question on the screen. This question is there at the end of this chapter. Just find out the number in the cell practice part. It would be there. 46 number. Now close the book. It is there, 46. Entity as an existing freehold factory property. Existing freehold factory property which it intends to knock down and redevelop. During the redevelopment period, the company will move its production facility to another site. Company will shift the production facility to another site. The following incremental cost will be incurred. Setup cost of rupees 5 lakh to install machinery in the new location. Rent 15 lakh. Removal cost of 3 lakh to transport the machinery from old location to temporary location. Can this cost be capitalized into the cost of the new building? Which of these would be capitalized? Or none of these would be capitalized? None of them will be capitalized. Setup cost will not be capitalized. No, setup cost is incurred to install machinery in the new location. They are asking you which cost will be capitalized into the cost of new building. Rent of that new location cannot be capitalized. And removal cost we have discussed in the first chart only. Cost will exclude the cost of shifting of machinery from one location to another. So the answer of this question is none of these three costs mentioned will be included in the cost of building. Okay. And how do you write the answer? These costs are not to be included in the cost of the asset as they are not directly attributable to bringing the asset to location and condition necessary for it to be capable of operating in the manner intended by the management. This cost to be incurred by the company do not meet the requirement of IAS 16, hence cannot be capitalized. Okay, now search for this question also. 47, close the book. 47. Entity A, which operates a major chain of supermarkets, has acquired a new store location. Okay, has acquired a new store. The new location requires significant renovation expenditure. Renovation expenditure. Management expects that renovation will last for 3 months, during which supermarket will be closed. Management has prepared the budget for this period, including expenditure relating to construction and remodeling cost. So this new supermarket will be constructed and remodeled. Second cost is salary of staff who will be preparing the store before its opening and related utilities cost. So once the construction and remodeling is done, then the staff will make the store ready. Okay. Which of these expenditure or what will be the treatment of this expenditure? Both will be capitalized. Option B. Both will be expensed. Option C. One will be capitalized, two will be expensed. And option D. One will be expensed, two will be capitalized. Both capitalized, both expensed, one of them capitalized and one of them expensed. What about this cost? Expenditure relating to construction and remodeling cost. Expense out, it's construction. It will generate benefit for a long term. The benefit will be earned by the company for a longer period. It's not shifting, it is the same location. This will be recognized an expense because these are the staff who was going to just make the store ready before its opening. So first answer is management should capitalize the cost of construction and remodeling the supermarket because they are necessary to bring the store to the condition necessary for it to be capable of operating in the manner intended by the management. Supermarket cannot be opened without incurring the remodeling expenditure, and thus the expenditure will form part of the asset. However, the cost of salary, utilities and storage of goods are operating expenditure and would be incurred if the supermarket was open. So second item, charged to P&L account. Okay, now one important discussion. Cost of PPE in exchange transaction, para 9. What is the meaning of exchange transaction? You give one asset and you receive a PPE in return. So my question is how that PPE which is acquired will be accounted for. Is it right? What we have acquired? PPE. What we have given? Any asset which can be another PPE, intangible asset or inventory or any investment or any kind of service also. Is it right? That is, I own a hotel, I say you stay in my hotel for 10 days and that company sells car, give me 2 cars in return. So here PPE is acquired in exchange for service rendered to the other party. 10 days hotel was provided free of cost to them. Not free of cost, you got 2 cars in return, right? So how to do accounting in such cases? So the standard says if a PPE is acquired in exchange of an existing asset, that means non-monetary consideration, the fair value of the asset given up or the fair value of the asset acquired is to be ascertained. Try to get the fair value of both of them, and the value whichever is more clearly evident will be treated as cost of the asset acquired. Okay, there is a note below. If PP is acquired in exchange for a non-monetary asset, then the golden rule number 1 is first you give priority to fair value. Then it should be recognized at its fair value. In case of exchange of one PPE against any other asset, first priority will be given to fair value unless the exchange transaction lacks commercial substance. Unless the exchange transaction lacks commercial substance means your cash flows are unaffected. Cash flows are unaffected. There is no commercial substance. Cash flows are unaffected. Okay, I'll give you an example of this case. Suppose this is this building where we are right now studying, the world famous Prestige Point. Okay, and there are 2 offices on this first floor, office A and office B. B sells his office to A, A sells his office to B. This is not going to affect their revenue, cash flow in any way. Both are identical. Is it right? In this example, we can say the transaction lacks any commercial substance. So what will be the treatment? We will not account it at fair value. Rather, we will account it at book value of the asset given up. Is it right? And sometimes we can't ascertain the fair value of either of the 2 assets. If we can't ascertain the fair value of either of the 2 assets reliably, then how do you measure the asset acquired? Book value of the asset given up. Is it right? So in these 2 cases, we will take book value of the asset given up if the asset transaction lacks commercial substance or if the fair value cannot be determined. Now we'll solve some simple questions first. If one fixed asset is taken in exchange for another fixed asset, say for example, machine A, is this question there? What is that question number? 10 below. Is it 10 number? Machine A is exchanged for motor car B, which has a book value of 1,50,000. Fair value of the car given up is 1,70,000. fair value of machine A is 1,80,000. Then the problem says fair value of the machine is more evidently known. What is the amount at which the machine acquired would be recorded? 1,80,000. Okay. And suppose the question says pass journal entry. Journal entry would be you will debit the machine acquired at fair value of the machine. You will remove the motor car, de-recognize the motor car from your books, whose book value is 1,50,000, because we have to de-recognize the asset transferred, and the difference will be transferred to statement of profit and loss, 30,000. Oh, the answer is also there. Search for this question. If a machine is taken by issuing 1,000 equity share of rupees 100 each, there 11 number only, then fair value of the machine or fair value of the security given up, whichever is more evidently or reliably known, will be considered. Say it is rupees 1,50,000. Journalize. Now in this question we have acquired a machine and we have issued our equity share for that. So what is the journal entry? First you debit the machinery at 1,50,000. Then you have to issue the shares. Face value is 100 rupees. So to equity share capital 1000 into 100, 1 lakh. What about the extra 50,000? To securities premium 50,000. Okay, one more try. X Limited purchased a machinery and 10,000 equity share of the company has been issued in consideration. The market price of equity share of par value of rupees 10 is rupees 12. Fair market value of the machinery checked from the price quotation as well as latest transaction price of the seller is 1,10,000. Find out the value of PP to be recognized at initial recognition. Now here we have two answers. 10,000 into 12, 1,20,000. If I take the fair value of the equity share, if I take the fair value of the machinery 1,10,000, now the student has to take a judgment whether this 1,10,000 is more reliably evident or 1,20,000 is more reliably evident. Vote for 1,10,000. Vote for 1,20,000. We have got both votes. The vote which is less in this kind of exam is normally the winner. Okay. The minority wins in professional exams. So the answer is 1,10,000. Why? See, market value of equity share versus the market value of that machine, which is more clearly evident. Today market value of equity share is 1,20,000. Next day it will become 119, 125, 130. It will keep fluctuating. But will the value of that machine change every day? And they have given you a hint also. You did not understand. Check from the price quotation as well as latest transaction price of the seller. Means if you ask 10 people, they will say this is the price of this machine. But price of the share changes frequently. So between the two, if the price of the particular machine itself is available based on the latest transaction price, that is more appropriate, more evident than the price of share which is listed on the stock exchange. Between the two, this is more appropriate. Okay, try this question. Number 13. A piece of machinery is acquired in exchange for a plot of land. The fair value of the machinery is agreed at rupees 2 lakh. And the fair value of the plot is 2,50,000, whose book value is 2,25,000. The difference of rupees 50,000 is to be settled by cash. Which 50,000 they are talking? You have acquired a machinery whose fair value is 2 lakh. and you are transferring a plot of land whose fair value is 2,50,000. Are you going to receive 50,000 or pay 50,000? Receive 50,000. Okay. What is the cost at which machinery acquired will be recorded at? Will you record the fair value of the machinery 2 lakh or fair value of the land 2,50,000 or 2,50,000 minus 50,000 2 lakh? Is it right? So in both cases your mathematic answer would be 2 lakh only. If I only take fair value of machinery, it is 2 lakh. If I take the fair value of land given 2,50,000 but we receive 50,000 cash also, so that also gives me a net amount of 2 lakh only. So the answer will be 2 lakh. Write down. The machinery acquired will be recorded at rupees 2 lakh. The machinery acquired will be recorded at rupees 2 lakh. The accounting entry will be machinery account debit 2 lakh, cash account debit 50,000, to land account book value, derecognize the land 2,25,000, and to profit on sale of land 25,000. To profit on sale of land 25,000. Is it right? Say yes. Now write narration if you want, otherwise ignore. Being the sale of land partially in exchange of machinery and partially for cash. Being the sale of land partially in exchange of machinery and partially for cash, and the resultant profit accounted for. Now write down homework today 14-15 with answers. You just have to go home and read it carefully. Next is, if it is not possible to ascertain the fair value of both the assets, then the net book value of the asset given up, not acquired. Acquired will not appear in your books. What will appear in your book? The asset given up will be treated as cost of acquisition. Okay. Now see, one small chart is prepared here for understanding. Case 1, 2, 3, 4. In your book, we'll go case by case. Fair value of the asset acquired is 12 and fair value of the asset given up is 10 and carrying amount is 8. Now if the fair value of both are given, then you have to see which is more clearly evident. Problem says 12, which means the fair value of the asset acquired 12 will be the cost of the asset acquired. So this new asset acquired will be recorded at 12. Understood? Second case, fair value of the asset acquired is not clearly evident, but fair value of the asset given is clearly evident. Now here at least one of the two is available. So the asset acquired will be measured at 10. In third scenario, the fair value of the asset acquired is given 12 and fair value of the asset given up is not clearly evident. At least one of the two is given. So we'll record the asset acquired at 12. But in fourth situation, not available, fair value not available, then in that case, the carrying amount of the asset given up will become the cost of the asset acquired. Is it right? Say yes. Yes. Now come to the next part of this chapter. Next is self-constructed asset. So this is also going to be tested in your exam. Self-constructed asset means the company is in-house constructing a property, plant, equipment. Normally, for example, office building, factory building, or some equipment, okay, or let us say some car for internal movement some truck for internal movement of goods. Okay, then in that case, how will you calculate the cost of the self-constructed asset? So here, like a cost sheet, you have to maintain a record of what costs are going into the construction of that asset. Train your employees that those who are working in this construction keep a record, and these costs, these expenses would be added to the cost of this asset. So first is all the costs which are directly attributable to specific asset. Second, cost which can be allocated. Cost which can be allocated. For example, power. One power bill you are getting, but that power or electricity is used for construction of this asset also. So you have to keep a track of how much power unit was consumed. Or supervisor's salary. If he is devoting half time on the supervision of this building, half of his salary will be added. Depreciation of those machines which are used in this construction activity, add that also. Okay, insurance cost, add that also if it can be allocated. But keep in mind, internal profit will not be included. You cannot make profit from your own self. Is it right? Okay, so now we'll solve some simple examples. An X department transfers materials to Y department at a profit of 15%, underline, and Y uses the material in manufacturing products for sale. One such product is to be used by the company as a non-current asset. The average transfer cost of the material received by Y from X per product is 11,500. This 11,500 includes a profit margin of 15%, and the average other cost is 3,500, and the total cost is 15,000. What is the amount to be recognized as non-current asset? So student who is in a hurry will say 15,000. But a good student will first remove the profit from this. How much profit is included here? 15 upon 115, because this is inclusive of profit. So you will write the answer like this. Format is drawn, just fill in the blanks. The total cost of similar products sold is 15,000 less internal profit. 15 by 115 into 11,500, 1500, and therefore amount to be recognized 13,500. Okay, try one more in the notes only. An entity constructs a building for its own use. It spends rupees 50 million on material, 2 million of which was lost in fire. This we will not include. And 5 million on wages and other direct expenses. For constructing the building, it uses borrowed funds of rupees 30 million, on which it pays interest of rupees 3 million up to the date of completion of construction. What is the amount to be recognized as cost of building? Anybody wants to answer? First you add cost of material, but do not include abnormal loss, 48. Wages, 5 million. Interest will also be capitalized, 3 million. So the answer is 56 million. Okay. Now check whether this question is there. It will be there towards the end of the chapter. Is it there? 67. You have 67 questions in this chapter. Wow. No book on earth contains 70 questions on PPE chapter. Okay. Only your notes. India's book contains. ABC Limited is installing a new plant. ABC Limited is installing a new plant at its production facility. it has incurred this cost of the plant, which is cost per supplier's invoice plus taxes 25 lakh, initial delivery and handling cost of site preparation, consultants used for advice on the acquisition of the plant, interest charges paid to supplier of plant for deferred credit. Tick mark this item, we'll discuss. Interest charges paid to supplier of plant. Plant you have already received, which is in the ready to use condition. Okay. Then estimated dismantling cost to be incurred after 7 years. And operating losses before commercial production. Tick mark. Please underline, please advise ABC Limited on the cost that can be capitalized as per IAS 16. So tell me, first item we will capitalize, second item delivery cost, third item site preparation, fourth item tick mark consultants fees. And what about that interest? Interest will be no, because interest is not paid on a qualifying asset. That plant that you have acquired was in a ready to use situation. Okay, only you have to install it. So deferred payment you are making to the supplier of plant, so that interest is not on a qualifying asset. And what about the initial operating loss? Will you also include that? No. Initial operating losses are not included. What about the dismantling cost? Dismantling cost, yes. Take the total. How much it comes to? Is it 43 lakh? Yes. So you can always write two notes also. Interest paid on deferred credit terms to supplier on a plant which is not a qualifying asset of 2 lakh, and operating losses before commercial production amounting to 4 lakh are not regarded as directly attributable cost and thus cannot be capitalized. They should be written off to the statement of profit and loss in the period they are incurred. Okay, try this one also. Don't read the answer. Question number 65. Don't turn the page. Give me the final answer. This can be a 5 to 8 mark question. Try yourself. You can do it. Read till the last line before you start taking total. Any answer? Okay, we'll check the answer now. First you write purchase price of land 30 lakh. Have you written? Total cost we need to find out, which can be capitalized. Then stamp duty and legal fees 2 lakh. Architect fees you have taken 2 lakh. Site preparation you have taken 50,000. But now be careful, material you will not take 10 lakh. Out of 10 lakh rupees material, 1 lakh has been spoiled, removed, and therefore wasted, and a further 1,50,000 was spent on account of a faulty design work. So abnormal material wasted is 2,50,000. Remove 2,50,000. So take only 7,50,000. What about labor? Take 4 lakh, but there is a note that rupees 22,000 of the labor costs relate to that period when the work was stopped for 2 weeks. So this is an abnormal labor cost. Remove it. Take 3,78,000. Have you added general overhead? No. Have you written interest also? Yes. For how many months this activity was in progress? For how many months this activity was in progress? So the work started on 1st April, and when did the work complete? 1st January. So 9 months. Loan amount is 40 lakh into 9 by 12 into interest rate 8%. The problem says it meets the definition of qualifying asset as per IAS 23. Is it right? So what you do? You take interest for this 9 months, 2,40,000. Take the total. What is the total amount that will be capitalized? 48,18,000. Try one more. This time little fast. This is 63 number. Take calculator, try little fast. Done. What is the answer? 92 lakh. After reading the answer or before reading the answer? Before reading the answer. Will you take 80 lakh rupees? No. From that you only deduct the trade discount. You will take, but deduct trade discount. What about the cash discount for early payment? Cash discount for early payment is shown as other income. Then import duty I will take, delivery fees I will take, electric installation will take, pre-production testing also we will take. But what about that maintenance contract with vendor 7 lakh? That is for maintenance of the asset for future. So that is a future service contract. That will not form part of the cost of the asset. Okay. So this is discussion on how to make initial recognition and also self-constructed asset. Now you come to this paragraph, subsequent cost. Okay, subsequent cost and replacements. But before that there is a paragraph number 11, bearer plant. I'll just read from the book. It's not appearing on the screen. Bearer plant. Bearer plants are accounted for in the same way as self-constructed item of property, plant and equipment. So the accounting treatment of bearer plant is same like self-constructed PPE. Why? Before they are in the location and condition necessary to be capable of operating in the manner intended by the management. So whatever cost you will incur to bring them into the location and condition, capitalize. Consequently, reference to construction in this standard should be read as covering activities that are necessary to cultivate the bearer plant before they are in the location and condition necessary to be capable of operating in the manner intended by the management. In case of bearer plant, we are not actually constructing anything, but we are doing all the activities like cultivating, which will make the bearer plant ready for producing the fruits or whatever. So therefore it is like self-constructed PP item. Now subsequent cost and replacement. Can we capitalize subsequent cost? So underline if recognition criteria are met. What was recognition criteria? If it is going to generate future economic benefit, its cost can be measured reliably and it meets the definition of property, plant and equipment. What about the replacement cost? Companies may replace some part. Okay. Replacement cost will also be capitalized and the previous item, that is a replaced part, will be derecognized. Similarly, companies may incur major inspection cost. Major inspection cost will also be capitalized if it meets the definition and the recognition criteria. So we will take the question on replacement and inspection tomorrow. Okay.